Alright everyone, Cowboy Trades here, welcome back to the channel for another update. So, the next FOMC decision is less than 1 hour away by the time I post this. I think the markets are getting ready for a major shock when the Fed raise their interest rates by 25 basis points, maybe causing the next market nuke. Let's talk about this. So, in the past few weeks or so, we've had a lot of talk about quantitative easing, which we have discussed on the channel. And since this came out, the Fed futures absolutely got decimated. The markets were expecting interest rates to push up to 5.6%. And now markets are starting to price in a cut. We're currently sitting at 4.4% underneath where the interest rates currently are at 4.75%. So, what do you think is going to happen if the Fed raised the interest rates by a further 25 basis point increase up to 5%? I think this is going to signal to the market, signal to the Fed futures that we still have higher to go. Now, I'm going to talk about why particularly I think that the Fed is still going to raise their interest rates a little bit later on in the video. But for now, let's talk about some price targets I've got for the S&P 500. And after this, I will make a Bitcoin specific video for you. So, diving into the S&P 500. In the video we made for the S&P 500 yesterday, we actually talked about how it's likely that the S&P 500 could move up to the top of this bear flag before continuing that next move to the downside. I mean, the reason being is because we do have a 786 Fibonacci up here. We do have previous range highs up here, which we didn't retest on the breakdown. And this is also in confluence with the top of the bear flag. And I did say, you know, don't expect some major move to the downside before the FOMC meeting comes. We have a lot of whiplashes. Typically we whiplash into it. Sometimes we'll have a 25 basis point increase. The markets will whiplash further back up and then whiplash back down. This is probably a very likely scenario for the S&P 500. We may even rally for the first hour after we do get that economic data come out, and then it's very likely that we start to crash down into it. So in terms of what I've got my eyes on in the immediate short term, expect the S&P 500 to trade just underneath the 786 Fibonacci at 4,030 for the next hour or two. And then moving down to the bottom of this bear flag, I think the S&P 500 will move down to 3,900, and the breakdown price target of this is 4,660. Now, volatility in the past few days has really kind of been stagnant. We do have the CBOE implied correlation up about 2% today, definitely telling us that a sizable move is probably going to come into the markets after the FOMC. Your volatility metrics such as the VIX and the VVIX are still up majorly from the past week or so. The VIX has retraced a lot of its gains, but the VVIX is actually saying that, you know, we should be slightly higher than we are right now for the VIX. So if we do slap over the VIX on this same pane, layer this up, move to the existing pane above, you can really see the VVIX is holding up a lot better since this most recent move. So I do think the VIX has some catching up to do, and it's very likely that the VIX starts to snap to the upside monumentally after we do have this 25 basis point increase. At least in my opinion, that's what I think we're getting. It's interesting to see that the markets right now, the S&P 500 is actually once again trading slightly above this bear market resistance that we've been getting crushed underneath. We are coming into confluence with EMA ribbons right now. You can see we're trading just underneath the long-term moving average of the bearish EMA ribbons. We get rid of these and look at the bull market support bands. We're currently sitting just above them, and almost, well, literally every single time you can see the S&P 500 topped above them, nuke. Topped above them, nuke, topped above them, nuke, then we broke back up, topped above them again, nuke, we topped out above them, we nuked, and recently we topped out above them and broke down, and now we're up above these again. So what we're witnessing right now, well, we've got a top, a break beneath them, a back test above them, and then potentially another breakdown, reminds me exactly of what happened over in August. And you remember around about August, this time was when we had our FOMC minutes meeting. So there's a lot of correlations I see lining up with the markets right now. We are, of course, still breaking to the downside of this 5-wave asymmetrical triangle in terms of the Elliott wave theory that we have been discussing on the channel. We just talked about these. I was going to talk about these over on this chart. As you can see, we are getting rejected underneath a lot of key moving averages for the markets right now. And in terms of my higher price targets, you know my price targets for the immediate short term. If we come back to our first chart, I think we need to move down to 3,920 in the immediate short term. After that, if we do get more continuation, after we get a 25 basis points rather, potentially even 50 basis points. I don't think that's really on the table right now. I think 25 basis points is much more likely, but we could come down to this price target at 3,660. A little bit more of a bleed out and continuation could allow us to come down and fill this price gap for the S&P 500 all the way down at 3,580. What do you think that's going to do for the Bitcoin markets? Well, I'll let you know in my Bitcoin video in about an hour or so, half an hour maybe, but it's not going to fare well for the market. So why do I think 25 basis points? Well, for one major reason, what has changed? Nothing has changed. Have we had any Fed commentary coming out saying the Fed are going to pivot? No. Have we had the Fed come out and say anything different than they've been saying for the past few months? No. Has anything changed in the greater markets? No. What has the Fed been telling us? The Fed have been telling us interest rates needs to go higher, the terminal rate needs to go higher, they've been telling us that they're keeping their eyes on the job market and they're keeping their eyes on core inflation. Core inflation has been moving, a 0.1% decrease every month from 5.7% in January to 5.6% in February to 5.5% in March. At this rate, it's going to take years and years and years to get down to 2%. So, of course, they're going to still be needing to raise their interest rates. They can't stop right now. They've got a job to do. We also know that they've been telling us they have their eyes on the jobs market. They want to see softening in labor conditions. They want to see, average hourly payroll go down. They want to see the US non-farm payrolls start to go down, as well as the unemployment rate goes up. But unemployment rate is historically low right now. Last month, the US economy added 311,000 jobs. While we talked about a lot of different things over in this video. We talked about how this hot job report crashes the market. We were looking at lots of different things for the job market. Average hourly earnings actually shot up to 4.6%, and they were previously at 4.4%. So we're not seeing a softening in labor market conditions. We're actually seeing a hardening, and as we've been discussing, they are looking at core inflation, and this is not moving at this moment in time. They really need to either just continue with their 25 basis point increases, or they need to step it up. And a lot of people have been talking about, hey, has the Fed turned back on quantitative easing? There's a massive misconception about this right now. We covered this over in this video here. Has the money printer returned? Of course, we all know that the Fed's balance sheet increased by 300 billion. However, when you look at the definition of quantitative easing, and when we did a breakdown of the balance sheet, I highly recommend you go and check out this video. We obviously found out that we have not got quantitative easing right now. That is a massive misconception. Another argument of why the Fed might have to pause their interest rates is, hey, banks are suffering right now. Banks are going bankrupt. If they keep on raising the interest rates, this could cause huge systemic risk. If that is true and that is how the Fed think, then they would just pivot the interest rates. They wouldn't also create funds to provide banks with liquidity. They don't need to do both. They either need to provide banks with liquidity using the new lending system that they've just incorporated, or they need to lower the interest rates. They don't need to do both. That's counterproductive. So we've already seen the Fed's response to this. They said, hey, we'll provide banks with more liquidity. We can do that. Why would they then go out and lower the interest rates as well? It's really not going to make any sense, in my opinion. We know what the Fed's been looking at. We know what the Fed's been talking about. And the markets, looking at the Fed futures, the markets are not believing the Fed. The markets have not believed the Fed for the past year or so. And the Fed has just religiously proved them wrong as they hike the interest rate. So, in my opinion, my friends, I think Fed futures have some catching up to do. They are currently down at 4.42%. If we raise the interest rates by 25 basis points today, then we will have the interest rate up at 5%, and the markets will be saying, hey, we were thinking it's going to come down to 5.4%. We were wrong. We now need to start pricing in further interest rate hikes. What do you think that's going to do for the S&P 500? I think that's going to take us down to 3,900, 3,660, and of course, 3,580 to fill this price gap. That's all I've got for you today, my friends. If you do enjoy my content, as always, let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, click the join button and become a member today. Make sure to follow me over on Twitter at 618_cowboy. But for today, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.